We prepare financial statements, but we should also know how to use the financial information we prepared. As investor or financial statement users, we prefer the outlook for the future rather than the historical information. Although financial statements mostly report historical financial position and financial performance, financial information can provide the useful information for investors to formulate the outlook of a company. Investors are mainly interested in the default risk and operational risk of the investee or the companies. Creditors mostly focus on the default risk because creditors' interest is the on-time payments of the principal and interest, which are related to the default risk. And which financial statement provide the information regarding the default risk? Balance sheet. Because balance sheet reports the resources, liabilities, and equities. If the company has a great portion of liability reported in the balance sheet, the company is considered to be more likely to default. Operational risk is reported in the income statement and statement of cash flows, because these two financial statements report the operating activity through both cash and accrual accounting. The greater operational risk usually reflect as a volatility in the revenues and profits. For example, if the company has revenue decline, also keep reporting net loss, we can say this company has increasing operating risks. The investors who are more interested in the operational risk are equity investors, because they have the claim to the bottom line, the profits. That's why profits has two outlets. One is paid out as dividend to the stockholders, and also retain earnings, reinvest in the company. In general, both creditors, the lenders, and the shareholders, they are interested in all the financial statement. But for lenders, they are more interested in the company's balance sheet, while equity investors focus on the income statement more. To learn the outlook of the business, the next topic is the financial statement analysis. There are four common methods include. One is comparative financial statements. Instead of reporting just 1 year financial statements, the companies are required to report multiple years financial statements for comparison. Horizontal analysis, we can choose 1 year, the first year as the base year, and then calculate the growth rate of each account in the financial statement to learn about the change in each account. Vertical analysis, this usually refers to the common size analysis. For example, all the accounts in the balance sheet are scaled by the total assets. So each account will be reported as a percentage of total assets. For income statement, each account or each item in the income statement is scaled by the top line revenue. Then each item in the income statement will be reported as a percentage of revenue. It's very useful for cross-sectional analysis. For example, the comparison between a big and a small company. In the following slides, I will introduce the most commonly used ratios or indicators related to the company's default risk or operational risk. For the comparative financial statement, here I used Google's or Alphabet filings, current 10K. The balance sheet, you can see it has the balance sheet of prior year and the current year. Google's 2024 will be available in a few weeks. So right now, the latest 10K was ended on December 31st, 2023. Anyway, if we use 2020 as a base year, we can calculate the growth rate of each account. So that's the horizontal analysis. For the vertical analysis, we have the total assets each year. For each year's balance sheet, each account is scaled by the total asset. Then we can have the percentage of each account of total assets. This is same for the income statement. Income statement usually reported for the past 3 years. And also we can do both horizontal and vertical analysis for these financial statements. Statement of cash flow is same. Yeah, we can also, do the same thing for statement of cash. Let's do a practice. So the answer is default risk, which describes the risk of a company cannot pay its obligations at full amount or on time. Here I'm going to introduce a set of financial ratios that are derived from balance sheet, which represents the different aspect of a corporation. So here the first one is the liquidity ratio. And liquidity ratio are ratios that describe the ability of a company to convert its assets to cash to satisfy the current liabilities. Based on this definition, no matter what liquidity ratio, its purpose is to evaluate the company's ability to satisfy the current liabilities. For example, the current ratio, it is ratio between current assets and current liabilities. So here, the denominator is current liabilities. And this ratio describes whether the company has sufficient current assets for their current liabilities. Usually, company will liquidate their current assets to pay off their current liabilities. The next one is quick ratio or acid test ratio. This ratio just excludes inventory from the numerator. Denominator is the same. For the quick asset, it is just current assets that exclude inventory. So the assets included are more quicker. So that is a quick ratio. These two ratios are borrowed the numbers from current assets, current liabilities. The next one evaluate the company's liquidity is working capital. The definition of working capital is the difference between current assets and current liabilities, which is similar to the current ratio. Current ratio is current assets divided by current liability, while working capital is a difference. Basically, these two indicators are same. If working capital is greater than 0, that means current assets is greater than the current liability, so the current ratio will be greater than 1. Current ratio is a ratio while working capital is a dollar amount. It's better to use both ratio when analyze the liquidity. Here, the PowerPoint provide an example. The company has current assets $20,556 million, while current liabilities is a lot smaller. These two numbers are on May 31st, 2020. If we calculate the current ratio, it was 2.48. That indicates the company has $2.48 current assets for each dollar of current liabilities. Usually current ratio greater than 1 is good. But it doesn't mean the greater current ratio is better, because we may question whether the company utilize its assets efficiently. For example, if the company has too much cash on its balance sheet, well, cash does not generate return or generate minimum return, right? So we may question why the company keep these high liquidity assets on their balance sheet instead of investing in other productive assets. As long as the company maintain a reasonable current ratio, it is okay. While current ratio is just one ratio, if we want to know whether the company has a liquidity issue, we should borrow other financial ratios to have a more comprehensive analysis. And different industries, different companies may have different liquidity requirements. The example of asset test ratio, this one exclude inventory, prepaid items, and restrict cash. Any current asset that behind inventory in terms of the liquidity are excluded. So the quick assets is smaller than the current assets, or the quick assets is a subset of current assets. So for the same company, asset test ratio or quick ratio is smaller than the current ratio of prior slide. We can calculate the liquidity ratio based on the balance sheet, while the ratio itself doesn't tell us anything super valuable. For financial analysis, the best way to know the risk and the profitability is to find an appropriate benchmark. So usually we may use the peer firms, firms in the same industry with similar size to compare the ratio between the company and the peer firms, or the average of peer firms, or just compare to the industry average or in industry median. Depends on different research settings, different data sources, and different industries. We are provided the industry's average for current ratio and the quick ratio, while Nike outperformed these ratios. This is a preliminary analysis. The next multiple choice question is, the answer is D. Why this transaction increase the company's liquidity ratio? The company signed a 3-year note. That means the company will receive cash from this agreement, which the cash is current assets, while this debt is long-term. So it won't have impact on the current liabilities. Others pay dividends as cash outflow. The current assets decrease, but current liability stays. So this will reduce the current ratio. Purchase office supply with cash. So this office supply and the cash both are current assets. So the current assets doesn't change. Receive cash from customer on accounts receivable, same. The received cash, the cash increase, accounts receivable decrease for the same amount, both are current assets, so the current ratio doesn't change. Or even the quick ratio doesn't change. Following the liquidity ratio, I will introduce another one, solvency ratios, which are ratios describe a company's ability to pay its long-term debt, not just current debt. So the two solvency ratios introduced here are debt to equity ratio, which is the ratio between total liabilities and the stockholders' equity. Well, the other one is times interest earned ratios, which is a ratio between the sum of net income, interest expense, income taxes with the interest expense. This ratio here, the net income represents the claim of the shareholders. Interest expense represents the interest claim from the lenders or creditors. Income tax represents the claim from the government. This represents the source that can cover the company interest expense. The debt to equity ratio, it compares the claim of the creditors to the claim of the owners. This is a very important ratio for the potential creditors or lenders to make their lending decision regarding the amount of a loan and the interest of a loan. In general, if the ratio is higher, it indicates the company has greater default risk. For Nike, if we use a number from its balance sheet, we can get the debt to equity ratio 2.89, which is pretty high comparing with the industry average. You may ask why Nike can have this higher leverage or the high debt to equity ratio. The reason is Nike has pretty mature business, strong customer loyalty. Its earnings and operating cash flows can afford higher debt. To the creditors, they are considered lower risk. That's why Nike has the capacity or ability to have a greater debt to equity ratio. I want to emphasize when we analyze a company's profitability and risks, we should use multiple financial ratios and methods. A single ratio does not tell the whole story. How to interpret the results of the ratio is more critical. So in this case, Nike's higher debt to equity ratio now means Nike has greater default risk or solvency risk. It can also indicate Nike has strong financial performance to afford higher leverage. So when we analyze the solvency, we should also consider the profitability, the ability of the company to generate free cash flows. Times interest earned ratio. This ratio represents a company needs to have funds available to pay interest charges. The numerator is the sum of net income, interest expense, and income tax expense. Is the income before interest expense and income tax. So the numerator is the income that is available to pay for this interest expense. In Nike's case, this ratio is 20.12. That indicates Nike can generate plenty of earnings to cover its interest payments.